Hello and welcome. My name is Hamza. I will be introducing you to the best alternate to conventional banking and finance, the Islamic finance. I would like to quote Nigerian President Obasanjo from the G8 summit held in year 2000. All that we had borrowed up to 1985 or 1986 was around $5 billion, and we have paid about $16 billion, yet we are still being told that we owe about $28 billion. That $28 billion came about because of the injustice in the foreign creditors' interest rates. If you ask me what is the worst thing in the world, I will say it is compound interest. It's clear that interest is the root cause of most of the world problems. The best solution in the current global economic climate is Islamic finance because this system is built on fairness and transparency. Before we begin this program, let me tell you that this training program is structured into 12 comprehensive modules covering every aspect of Islamic finance, from the philosophical foundation of prohibiting interest, riba, to practical execution of murabaha, musharakah, mudarabah, ijara, salam, istisna, takaful, and sukuk. Each module contains detailed explanations, real-world examples, discussion questions, and key takeaways. Let's begin. We need to understand why Islamic finance exists. The entire system, every product, every contract, flows from one central principle. Interest, riba, is harmful and prohibited. Let me start with a question. How many of you have heard of Nigeria's debt crisis? The Quran explicitly prohibits riba, any guaranteed, predetermined return on money lent. This is not merely a technicality. It represents a complete worldview about fairness, risk, and wealth distribution. Let's take real-world example. The Nigeria case study. President Obasanjo stated at the G8 summit in Okinawa, 2000, Nigeria borrowed around $5 billion up to 1985 to 86. It paid back $16 billion. Yet was told it still owed $28 billion. That extra $23 billion emerged purely from compounding interest at only 15.6% per year. Meanwhile, UNICEF estimates over 500,000 children under 5 die each year globally due to the debt crisis. This is the human cost of compounding interest. Now I want you to imagine the same $5 billion had been invested through Islamic finance, through a Musharakah, partnership, or a mudarabah. The Nigerian government and the Islamic Bank would be partners in infrastructure, agriculture, or industry. If Nigeria prospers, both profit. If Nigeria struggles, both share the loss proportionally. There is no compounding debt spiral. Let's explore why this makes such a difference. Islam does not reject private ownership or the profit motive. The key difference is that, in capitalist systems, profit and private ownership operate without divine constraints, guided purely by law and market forces. In Islamic economics, the Shari'ah places boundaries on how wealth is created and distributed, ensuring fairness, asset backing, and risk sharing. Key principle: asset-backed financing. Every Islamic finance transaction must be tied to a real, tangible asset or a legitimate service. You cannot earn money simply by lending money. Money must be put to work in the real economy. This prevents the money out of thin air problem that caused the 2008 financial crisis. Let's see another real-world example. Nick, the UK homebuyer. Nick takes a conventional mortgage of £200,000 at 5% over 25 years. He pays back £350,000 total, £150,000 in pure interest. An Islamic bank would instead co-own the house with Nick, diminishing Musharakah, charge rent for the bank's share, and transfer ownership incrementally. Nick's total payments are similar, but every pound is tied to real ownership, not interest on a loan. There are 4 things that define Islamic finance. Remember these. They are the filter through which every product must pass. First, prohibition of riba, interest, no guaranteed return on money. Return must be tied to the performance of a real asset or business. Second, prohibition of gharar, excessive uncertainty contracts must be clear. Prices, quantities, and delivery dates must be known. Gambling is prohibited. Third, prohibition of macer, speculation/gambling. Purely speculative transactions with no underlying economic activity are forbidden. And fourth, asset backing requirement. Every transaction must create or relate to a real asset or a legitimate service. How Islamic banks compare to conventional banks. Islamic banks and conventional banks share many similarities. They both mobilize savings, finance businesses and homes, manage risk, and provide transaction services. The key differences are: conventional bank lends money at interest, debtor-creditor. Fixed interest return regardless of borrower's profit/loss. Money can create money, compound interest. Islamic bank invests in assets or partners in business, partner/investor. Profit/loss shared based on pre-agreed ratios tied to actual business results. Money must be converted to assets or services first, then profit is earned. Let's take a look at Nick's home buying example in detail to understand how Musharakah works. Nick has lost his job, his house, and all the money he had spent paying off his mortgage. The property bubble that triggered the global financial meltdown could not have happened if the properties had been financed Islamically. Why? Because a conventional bank merely lends out cash. Legally, it can keep lending this cash over and over, well above its actual cash reserves. An Islamic bank, on the other hand, has to take direct ownership of an actual asset, whether for a longer period in a lease or partnership or a shorter period in a sale or trade. Islamic finance always limits the institution to an actual asset. The word musharakah refers to a partnership in Islamic finance, and it's called a diminishing musharakah because the bank's equity keeps decreasing throughout the tenure of the financing, while the client's ownership keeps increasing through a series of equity purchases. Eventually, the client becomes the sole owner. If Nick had lost his job with a diminishing musharakah, at the very least he would still have an equity stake in an actual property that he could monetize. Let's take a $220,000 house, and let's say the customer puts down $20,000 and finances the remaining $200,000 from the Islamic bank. Let's also say that the financing lasts 20 years and the bank sets a 5% profit rate. For the sake of simplicity, we'll make it 20 annual repayments. The homebuyer's equity purchase of $10,000 is a simple straight-line calculation of the $200,000 divided by the number of years for the financing, 20 years. We subtract this $10,000 each year from the bank's total balance to get the next column, the bank's ownership, which, as we see, keeps going down each year until the bank owns none of the property. Next, we calculate the homebuyer's rent. This is equal to the bank's ownership for that period multiplied by the bank's profit rate. This number also keeps declining each year, because as the bank's ownership declines, so does the homebuyer's rent. Lastly, we calculate the homebuyer's total annual payment. This is simply the homebuyer's equity, purchase plus his rent. This number also keeps declining each year until the homebuyer eventually becomes the homeowner. At no time does the homebuyer pay any interest. And, certainly, at no time does any payment compound. The homebuyer just pays for two things: the house, in small payments, little by little, and the rent, for the portion of the house he doesn't yet own. This simple structure is something that just about any conventional bank can offer today. It takes a leap of faith for banks accustomed to interest-based lending to suddenly become direct stakeholders in property. But as the growth of Islamic banking shows, these concerns are misplaced. Call it Islamic finance, ethical finance, or conventional finance. When a bank takes real ownership of an asset, economies don't fall apart like a house of cards. Now, before I leave you with the discussion questions, let's take a quick recap of what we have learned. Musharakah is an Arabic word which literally means sharing. In the context of business and trade, it means a joint enterprise in which all the partners share the profit or loss of the joint venture. Interest predetermines a fixed rate of return on a loan advanced by the financier irrespective of the profit earned or loss suffered by the debtor, while Musharakah does not envisage a fixed rate of return. Rather, the return in Musharakah is based on the actual profit earned by the joint venture. The basic rules of Musharakah. Musharakah is a relationship established by the parties through a mutual contract. Therefore, all the necessary ingredients of a valid contract must be present. For example, the parties should be capable of entering into a contract. The contract must take place with free consent of the parties without any duress, fraud, or misrepresentation, etc. The proportion of profit to be distributed between the partners must be agreed upon at the time of effecting the contract. If no such proportion has been determined, the contract is not valid in Shari'ah. It's necessary for the validity of Musharakah that each partner gets the profit and loss exactly in the proportion of his investment. Therefore, if a partner has invested 40% of the total capital, he must get 40% of the profit if the joint venture was in profit or 40% loss if the joint venture produced a loss. Not more, not less, and any condition to the contrary shall render the contract invalid. Every partner has a right to take part in the management of Musharakah and to work for it. Every partner has a right to terminate the Musharakah at any time after giving his partner a notice to this effect, whereby the Musharakah will come to an end. In this instance, the Musharakah termination conditions in the contract agreed between the partners shall prevail. Now, let me give you the discussion questions. Question 1. Why might asset-backed finance be more stable during an economic crisis than interest-based finance? Question 2. A student says, Islamic banking and conventional banking look the same to me. Same payments, same result. How do you respond? Question 3. What is the moral difference between charging rent on a house versus charging interest on a loan for that same house? These questions are for you to self-assess your understanding of Musharakah financial model. Feel free to pass your comments in the comments section. Give my channel a like and subscribe. I'll see you in the next video.